The beer taps are dry now. The neon sign above the empty desks still glows, some motivational word about hustle or community, but there is no one left to read it. Rows of desks sit untouched, chairs pushed in, a dead office plant by the window. Phone booths built for private calls stand silent, their glass doors fogged with dust. This floor once belonged to a company worth $47 billion, more than most airlines, more than most banks in America. Today, it is worth nothing. The company that owned this floor filed for bankruptcy, and the man who built it walked away believing he had reinvented the office forever. He hadn't. He had leased a great deal of real estate and convinced the smartest investors in the world it was something else entirely. But to understand how it all fell apart, you have to go back to the beginning, to one pitch, one office in downtown Manhattan, and one man who could sell almost anything to almost anyone. In 2010, Adam Neumann and Miguel McKelvey were two men with an idea and not much of a track record. Neumann had already tried and failed at a few small ventures, including a business selling collapsible high heels. McKelvey was an architect's son who had grown up partly on a commune in Oregon, raised communally by a group of single mothers. Between them, they landed on something deceptively simple. Take unused office space, divide it into flexible desks and private suites, and rent it to freelancers, startups, and small businesses that couldn't commit to a 10-year lease of their own. In 2011, they opened their first location in Soho, Manhattan. It looked like nothing else on the office market. Glass-walled rooms, exposed brick, communal kitchens, beer on tap, a sense of belonging built directly into the architecture. Neumann rarely talked about it as an office rental company. He talked about energy, about community, about elevating the world's consciousness. He said WeWork's mission was to make a life, not just a living. Investors, many of them far outside the traditional real estate world, ate it up. Underneath the language, the mechanics were straightforward and old. WeWork signed long leases, often 10 or 15 years, locking in relatively low rent on large blocks of space. Then it subdivided that space and rented it back out in small increments, on flexible month-to-month terms, at a considerable premium. It was arbitrage, dressed up as revolution. The company was, in substance, a landlord with better furniture, but it called itself a technology company, and in the 2010s, that label alone was worth billions in valuation. Silicon Valley was flush with capital hunting for the next Airbnb or Uber, a business that could scale exponentially and eventually swallow an entire industry. WeWork positioned itself as exactly that kind of story. A platform, a network, a piece of software for real life, even though its core physical asset was drywall, glass partitions, and desks. Growth was explosive. WeWork expanded from a handful of buildings in New York to dozens of cities across the United States, then to countries around the world, from London to Tokyo to Tel Aviv. It went on an acquisition spree that had almost nothing to do with office space. A wave pool surfing company, an elementary school, a marketing agency, a social network for runners. Each new acquisition fed the same narrative, that WeWork wasn't one business, but an entire ecosystem, a philosophy, Then the money that had been trickling in became a flood. The Japanese conglomerate SoftBank, led by the billionaire Masayoshi Son, met Neumann and reportedly decided almost on the spot to go big. SoftBank poured in billions of dollars across multiple funding rounds. Late in 2018 and into early 2019, fresh SoftBank investment pushed WeWork's valuation from around $20 billion to roughly $47 billion. It was now one of the most valuable startups in America, worth more on paper than most companies listed on the stock exchange at the time. Neumann walked the halls of buildings he leased around the world like a prophet, telling employees WeWork would one day be valued in the trillions, that it would end world hunger, that it would even colonize Mars. Almost nobody in the room seemed to ask the one question that mattered. How much money is this company actually making? From the outside, WeWork looked unstoppable. From the inside, the numbers told a different story, one that got worse the faster the company grew. Every new location meant a new long-term lease, new build-out costs, new furniture, new staff, all paid up front, long before enough tenants signed on to make that particular space profitable. The model wasn't just capital-intensive, it was structurally backwards. WeWork owed landlords money on fixed decade-long terms, while its own customers could leave with a single month's notice. In a downturn, that mismatch would be dangerous. In the meantime, growth simply meant faster, larger losses, and WeWork kept calling that growth success. Governance mattered here as much as economics, and Neumann's control over the company was close to absolute. He held a class of stock that gave him outsized voting power, letting him run WeWork more like a personal project than a company answerable to a normal board. He personally owned stakes in several buildings that WeWork then leased, collecting rent, in effect, from the very business he ran. He trademarked the word. In August 2019, WeWork filed the paperwork to go public. Under the rules of an initial public offering, a company can no longer control its own story. It has to open its books to everyone who wants to look. The prospectus landed like a confession. WeWork had lost about $1.9 billion in the previous year alone, and the losses were accelerating, not shrinking, even as revenue climbed. There was no clear, credible path to profitability anywhere in the document. Analysts and journalists who read it closely found related party deals, including leases with buildings Neumann personally held stakes in, and a governance structure that gave him near total control despite the company burning through cash at an extraordinary rate. Public market investors who don't get swept up in a founder's charisma the way private venture capitalists sometimes do took one look and turned against it almost immediately. The banks underwriting the IPO, who only weeks earlier had floated valuations north of $60 billion, slashed their estimate of WeWork's worth to around $15 billion or less. Roadshow meetings meant to build excitement instead surfaced hard, uncomfortable questions Neumann had rarely had to answer in public before. Within weeks, the offering that was supposed to cement WeWork as one of the most valuable companies in America was quietly put on hold, then withdrawn entirely in September 2019. The fallout moved fast after that. WeWork's own board, backed by SoftBank, moved to remove the man who had built the company from the top. On 24 September 2019, Adam Neumann resigned as chief executive. He gave up his controlling stake, but he did not walk away empty-handed. His exit package, in stock, loans, and fees, was valued at around $1.7 billion, a staggering sum for a founder leaving behind a company in freefall. SoftBank, which had already committed billions to keep WeWork alive, took control of the business outright. It wasn't enough to rescue the valuation. Within a year, the company that had been worth $47 billion was valued at around $8 billion. WeWork tried once more to go public in October 2021. This time through a SPAC merger, a faster, less scrutinized route onto the stock market than a traditional IPO. It listed at a valuation of about $9 billion, a fraction of its old peak, proof that the underlying business had never actually grown into the story that had been told about it for a decade. The final act came on 7th of November 2023, when WeWork filed for bankruptcy. The leases that had once been the engine of unstoppable global growth were now simply liabilities the company could no longer carry, spread across hundreds of buildings in dozens of countries. When the dust settled, the numbers were almost hard to believe. SoftBank, which had bet so heavily on Neumann's vision, ended up losing a cumulative total of about $14 billion on WeWork. Masayoshi Son, one of the most aggressive and celebrated investors in the world, later called the investment a stain on his life, a rare and public admission of failure from a man whose entire reputation was built on backing world-changing bets. Adam Neumann, meanwhile, did not disappear. He left with a personal fortune intact, and years later returned to real estate with a new venture, backed once again by outside investors willing to bet on his ability to sell a vision, this time with somewhat more skepticism attached. The buildings themselves mostly kept operating, sold off, restructured, absorbed by new owners, the desks and glass offices outliving the company that first built them. What WeWork leaves behind isn't really a story about co-working or beanbags or kombucha on tap. It's a story about the gap between a great pitch and a great business, and how much money the modern financial world will pour into that gap when the story is compelling enough and the person telling it seems certain enough. For years, growth itself was treated as proof of a working business, when in WeWork's case, growth was the exact mechanism that made the losses worse. Nobody wanted to check the arithmetic while the valuation kept climbing higher every year. The public markets, when WeWork finally had to face them, did the one thing Silicon Valley culture rarely demands of its favorite companies. They asked to see the actual books. It took one prospectus, one honest look at the numbers, to end a decade of belief. WeWork wasn't destroyed by a recession, a scandal, or a competitor. It was destroyed by its own arithmetic, finally forced into the light after years spent in the dark.